Good morning. This is Jim Riggio. Today is November 1st, and I'm going to be doing a month-end review so far for our trade, for our Kevlar trade. What you're looking at here is just the daily 5-minute chart for the SPY. We ended up speaking during the week after the Fed announcement. You can see the Fed announcement was originally a big sell-off, and then we ended up bouncing up. A lot of traffic, okay, the next day. The thing that was concerning, okay, was that, we thought that going into the afternoon, everything looked really, really strong. A bit of a sell-off, and then I didn't like the way we closed, right, in terms of the market ended up having a little bit of selling pressure on it. If you end up taking a look at where the oscillators are, and here's a different picture of the oscillators. This is just a longer-term chart here going back more about a year or so. You can end up seeing that the oscillators, okay, the MACDs are starting to narrow. They are decreasing. The full stochastics, okay, are starting to flatten out. They've been, as I call it, living on the ceiling here. The fast stochastics have turned negative a little bit. The RSI, the Williams %R, and the CCI have all started to turn down a little bit. Are we overbought a little bit, and can we end up selling down? Yes, perhaps. What I like to end up doing is that I like to end up taking a look at the charts. Let me show you this. If I come over to here, let me come back to here and take a look at a longer term chart. Let me just go to a daily, go to a couple of years. And now if we take a look at Fibonacci's, this is the Fibonacci that I've been using now for a while. I had used the Fibonacci to the first peak, but when we had 1, 2, maybe 3, 4 more peaks that ended up seeming to hold. This is the Fibonacci that I've been using here. You can see that when we ended up retracing, it was kind of strange that we ended up going past the 23, but we didn't go all the way back to a full correction. That was kind of bullish, even though we did have these 4 horrendous days of selling. And we continue to end up going down much quicker than we go up. And you saw that both on the daily chart. So there is some apprehension in the market, but they need reason to sell. I think it would be very healthy for this market to end up correcting at least down to, if not the 61.8, at least to the 50 Fibonacci, or one of these previous highs that we ended up having before we had that sell-off in October. So there are the numbers that I end up taking a look at. So still want to end up being more protective to the downside than to the upside. If we take a look at our trade, this is our current trade right now. Okay, you can end up seeing it was the original trade that we put on where I had a 75-point call wing and a 100-point put wing. That's pretty standard for a Kevlar. I like to end up doing them unbalanced. I did need to end up having one, call to be able to flatten myself out somewhat. If you remember, we ran up, and what I had to end up doing, there was the one call, by the way, I'm sorry, I wasn't all the way up. We had to take it off and we had to roll it up. And when I ended up rolling it up, because the skews were flatter, meaning the implied volatility was lower, and the skew, the implied volatility of the puts below the money got to be much higher, more significantly. When we rolled it into a flat 100-point structure in terms of an iron condor, but I needed a second put. And I haven't ended up changing it since. If I come just to the expiration graph, I know some people would prefer to end up looking at that. Quick comment to those who end up preferring to look at the expiration graph. We're not going to hold to expiration, and I know that you get used to this, but you really should be looking at a day step. I always end up doing a day step and then maximizing my number of steps until I can get to the expiration graph, but not beyond it. You can end up seeing that as we move further in time, this will get more and more negative. So if we pull back slightly, like we have over the last 2 days, we lost a little bit less than 1%. We pulled back. I'll keep this on. Okay, but if we stay where we are, or if we move higher, I will have to end up adjusting. We've gone through the different adjustments, and these were the adjustments that I've shown you last time. I ended up having another iron condor in that I took a look that I would end up buying back to maybe do a little bit of a bigger roll. Again, just end up looking at our adjustments. I can end up buying another vertical. You can see that another call. You can see the call slightly higher than what we ended up buying it last week. I guess it was a week and a half ago. We could end up rolling our two calls, further back. Right now they're at 2,000. By rolling them back to 1950, 50 points, it would only cost us $42. So we'd have about $7.70 or so that would end up helping us with our theta and also helping our delta. So when I do that, I want you to watch the delta and the delta here and the theta here. You can see that the theta ends up going from 13 up to 14.5, so 13.2 to 14.5, and the deltas go from -7 to minus 5. Okay, so you can see the difference between. So it ends up helping, somewhat. I do like this adjustment. It does add a little bit more risk on the downside, but I think we've got plenty of room on the downside. I'm always fearful, though, that we can end up running through it. The other thing I can do is I can take the short call and I can roll it up, some number of points. Here what I looked at was rolling the 2025, rolling it up 15 points to 2040. So when you take a look at that, that significantly reduces my delta. It helps my theta somewhat. Does end up adding more risk here. You can see that it's a split strike. And what I end up doing when I go through it, I'll take a look and see, how does that end up helping my Greeks? I'll end up taking a look. What happens if I only moved it up, let's say, 5 points? Well, you can see here that it barely nudges, right? It barely nudges my deltas. I would go from 7.2 or 7.19 to, so it ends up helping. It ends up really doesn't do much for my theta. If I end up taking a look at what it will end up doing, say if I go up to 40 points, up to 2040, which is 15 points, you can end up seeing it really reduces my delta to almost flat. My theta ends up helping a little bit, but now I have more risk on the other side. So how far I end up rolling, it will be 5 points, 10 points, 15 points or more, is going to end up a lot of times looking to see what would end up being best. If I'm going to roll this call higher, remember this is a short call because it's an iron butterfly, I'll also prefer to end up taking my long put and rolling it higher. When you do these things together, I've always just looked at this as a risk reduction. If you take a look at Tom Nunemaker did a video earlier this week on a reverse Harvey. We've been calling this a reverse Harvey for many, many years. Basically, it was just methods of adjustments. Do you take, you're in a butterfly or an iron condor, do you take your long wings and you roll them in, or do you take your short wings and roll them out? So I guess on this side I'm doing a reverse Harvey. On this side I'm doing a Harvey. Okay, so it's a half of each. I end up looking at it. If I end up doing this, you can end up seeing that this ends up reducing my risk. It takes me from where I would have been at $5,000 and change to just about $4,000. So it takes, over $1,000 off of the table versus doing this, right? We're here at just under $5,400 in risk. You can end up seeing, if I do it this way, we're just over $4,000 in risk. So, it is significant. Of course, it shortens up the backside, okay, and it does mean that I'll have to end up adjusting. But you can end up seeing that I have at least, 30, 40 points. I do like this trade. It ends up helping my theta. My delta, but it doesn't do anything for my theta. Matter of fact, it ends up hurting it. So that's why I've been so reluctant to end up doing this roll yet, because it doesn't end up helping overall. If I end up rolling this 25 points instead of just the 15, you can see it reduces even more, but it ends up right in here. So you can see the difference. -4.25, 12.5, versus when I do it this way, a little over -2.1 versus 11.75. So it is much more of a later trade. So at this point, if I was to do anything, I would end up doing rolling my calls further back. It ends up helping with my theta. It ends up helping with my delta a little bit. It does bring my risk up to $5,000. But I'm going to end up waiting for the markets to open up on Monday, see where we are, and if I need to, I'll have to end up reevaluating, okay, what my Greeks look like. Because remember, when the market moves, it's not just the price that moves. Not only will all of your delta shift, but all of your Greeks are dependent on how high your implied volatility is, and that will obviously shift. Anyway, thanks for listening, and I will do an update in another couple days. Thanks, bye now.